Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. Thank you, as always, for joining. We've got a relatively short Market Carver for you, at least in terms of number of topics. We're going to talk about private markets and somewhat of the opaque nature in which that exists, and then Andrew is going to hit the Magnificent Seven, something we have to keep our eye on each and every week. So let's just dive right into private markets. Private markets have been a topic that have been growing and growing and growing as they become more popular in vehicles that have been more easy to access for the retail investor. Long was the exclusive nature for endowments and pensions and very, very large investors. Ultra wealthy families were typically the ones that invested in private markets, but this has become more available to the public. And it's certainly something we've been adding to our plate each and every year as solutions become available to us. But I think this is a good time to pause and talk about what you're really invested in and why you have to be sort of a buyer beware in terms of what it is that you're buying. So if you're buying a public market vehicle, which if you're watching this video, you undoubtedly are, when you get your statement each month, it's really easy to determine what those assets are worth. You take the last price trading of the day, whether it's a small cap stock or a big one. You take the last price that was agreed upon and traded at 4 p.m. Eastern time. And that's the value of the number of shares that you own, right? Real quick and simple. The bonds are a little bit trickier, but it's all anchored in some pretty easy to use math by finding reference point and how similar bonds are trading. However, when you turn to private markets, it's vastly different, and it's often up to the fund manager to say what those underlying assets are worth. There's kind of like your house, right? Nobody each day is coming by and saying what your house is worth. There has to be some estimates. There's got to be some appraisals, and there's no way to do that on a day-by-day basis. The best way and the best providers, in our opinion, use really reliable and truly independent third-party appraisers to come up with values. But I found this across Bloomberg, which really paints why we have to be careful, because some borrowers have money that they borrow from public lenders at the same time that they're doing it through these private funds as well. And there's 6 issues here from an article in Bloomberg, and the black line represents the price that was in the publicly traded vehicles. All right, just like a stock, it's changing hands, and that's the value of the bond at that point in time. But that same very issue is also held inside of private funds, and there's not one consistent way that providers use it. They can go from a high value all the way down to low. You may find one fund marking or pricing a bond or a loan at, say, 85 or 90 cents, and another one with the very same issue pricing it at like 55 or 60 cents. Very, very common in this market. And you can see here, oftentimes it varies from what the actual true public price has been. That purple dotted line represents the highest of that range, which deviates in these 6 issues quite a way. So to us, right, the problem here is if you're buying the funds there with that high mark, you're overpaying. Inheriting great risk to yourself. So this is something that we have to do our due diligence, and we certainly do if we buy any private market vehicles. At the very forefront there are how these assets are valued and how they are updated on an ongoing basis. Something we have to pay more and more attention to as it's becoming a bigger and bigger availability to you guys as investors. So that's the private market side. Andrew, we'll turn over to the Magnificent Seven.
All right, thank you, Adam. So this week, I just have one chart to share with you all, but we have 3 different pieces of data we're going to look at on it. So on this chart, we're primarily looking at the Magnificent Seven. That may be a phrase you've heard either in the media. It's definitely something we've been talking about on the Market Carver and in our allocation meeting. And this is just a group of stocks. At one point, you might have heard the term FANG, which is Facebook, Apple, Amazon, Microsoft, Google. Now we have the 7 as we throw Tesla and NVIDIA in the group as well. And why these stocks have this titling is because they become a massive share of the overall large cap market, and they've been the primary drivers for what's really helped carry the market higher. In fact, just these 7 stocks at the time of this recording, they account for just under 29% of all of the S&P 500. So we have roughly 500 stocks, and these 7 account for almost a third of the overall weight of the index. So they're very, very important as they've gotten so large. And so we really want to be able to track what their movements are doing and seeing, are they confirming or are they diverging from the trend we're seeing in the broad market? So on this chart on the top panel, we have a cap-weighted S&P 500. This is just your typical standard. When we say S&P 500, we're talking about the cap-weighted, meaning that it's weighted based off the size of the companies. The larger the company, the larger its weighting within the overall index. At the very bottom panel, we see equal-weighted S&P. This is where it doesn't matter how large the company is, how large or small, they all are equally weighted within the index. They all get the same amount of say in where the index goes because they all have the same weighting. Now, in the very middle, we have that magnificent seven, those seven stocks: Amazon, Apple, Microsoft, Facebook or Meta, Google, Tesla, and NVIDIA. And this, again, these are what's really been carrying the market higher. And we want to see these confirming the trends. As you can see with the green lines, we've been seeing all three of these different ways of looking at the market going higher, which is a good sign. It means not only is it just the largest stocks based off the Magnificent Seven or the cap weighting version of the S&P, but it's also equal weight. It's also been doing very well. And that's very encouraging for us. That's a bullish sign for the market. Now, here recently, we started seeing some of the Magnificent Seven become under pressure. Apple's beginning to struggle. Tesla has fallen back. It's no longer even one of the largest five companies. It's gotten replaced by Eli Lilly, JP Morgan, Broadcom. They've now actually increased their weighting above Tesla. And so we're starting to see some of these market leaders, Google kind of gets thrown in there as well. Some of these market leaders are starting to see their stock price be put under pressure. And so we're starting to see that Magnificent Seven as a whole, as a group, is also starting to pull back, not confirming the latest high that's being made by the index. Why is this important? Well, it could be for two reasons. One, we're seeing rotation in leadership. That's a great sign. Rotation is the lifeblood of a bull market, where maybe the market's starting to focus on other parts of the market, whether it's value stocks, financial stocks, different other stocks that maybe are taking their turn to lead the market higher. And if that's the case, that's a positive. The one caveat to that is what I started out talking about, is the weighting of these seven stocks. They account for just almost 29% of the market. It's going to be really tough for the market to go higher if we start seeing these stocks start to lag. We've seen this in the past where the market's dropped 5-10% because the leaders, this group of stocks, starts to decline. That's primarily what we saw in 2021, where these stocks some got cut in half, even more so, and it really put pressure on the overall market. And so once again, we're starting to see a little bit of divergence there. You see the blue line where they're making a little bit of a lower high while the rest of the market was making a higher high. Something we want to be aware of. If this starts to continue, we start to continue to see these leadership names start to go down, then that could be a foretelling note to what could happen for the overall market, and also create opportunity for maybe where we can start uncovering where the next set of leaders come from and try to take advantage of some new growth and new leadership. So it's something we're going to be watching going forward, and definitely keeping a close eye on to see who's going to be leading the market on its next leg up. Or if we start seeing the market begin to respond to what the Mag 7's doing and maybe see some more under pressure prices.
And Andrew, you are a rascal. I'm glad that you called yourself out there. That's really three charts now. Come on.
I put it all in one. I get credit for one.
We'll take it. We'll take it. So yeah, thank you. And thank you to all of you giving us your time. As always, we'll give you a reminder. Give us a call if we can be of service, 800-928-4001, or scan the QR code and book electronically. Thanks again and have a great weekend.